What's up, millennials? I often hear the question, how do I know when to buy a stock? And I hear people like Meet Kevin saying, well, you buy a stock on red days. Usually for most people, for most beginners especially, this is true. But I do it slightly different. I use technical analysis. Personally, I have been looking at Zoom to add to my position, and I finally did so on Wednesday. And in this video, I'm going to explain to you exactly why I bought on that specific day. Before we start, a few things first. First of all, Discord. I made a free Discord channel that you can have access to if you go to nesami.com/discord. Secondly, Stock O'Clock. These are very short 1-minute videos that I post every single trading day with news about the stock market. And third, don't trust me, verify me. I'm just a random dude on the internet. I'm certainly not a financial advisor. Today we're going to take a look at 3 different indicators. First of all, we're going to take a look at the exponential moving averages. The abbreviation for this is EMA. What is an exponential moving average? Well, a moving average is a line that tracks the average price of a certain stock, right? But this time it's an exponential moving average, okay? Not a simple moving average. What does that mean? Well, it means that it gives more importance, more weighing to the most recent couple of days instead of the first couple of days of a certain period. Let's take a look at an example. See this white line over here? This white line over here is the 55 exponential moving average, okay? This line indicates the average price of the last 55 days. So if it's at this point, then this point indicates the average price of the last 55 days before that, all right? The thing is, it's going to give more importance to the last 10 days, so basically like the days in this period, than the first couple of days right over here. Because of course, the most recent price action is the most relevant price action as well. All right, now we know that. Let's check out a few examples, a few indicators or EMAs that I personally use a lot. So what I use is the 8, 13, 21, and 55 exponential moving average. The 8 EMA is the fastest exponential moving average, if you will. That's this yellow line over here. 13-day EMA is the blue line over here. 21-day EMA is the purple line, and as we said, the 55-daily EMA is the white line over here. We are first going to take a look at the 8 exponential moving average, okay? So that is the trend line, or a line that indicates the average price of the last 8 days rather. Cool. So the 8 EMA is this yellow line over here. And we're going to zoom in a little bit over here. As we can see in this uptrend, we saw that the price, and in this case, the price is indicated by these candlesticks over here. So these red and green candlesticks over here. As we can see, these candlesticks almost never went below that yellow line, below that 8 daily exponential moving average. Right here, we can see it stayed above, it stayed above. Here, it actually came down a little bit, but quickly recovered and came back up. And it stayed above this yellow line all the way up here until it actually broke. It started to open and close below the 8 daily EMA, here as well, and that actually indicated the start of a downtrend. Now let's take a look at that downtrend that happened afterwards, okay? As we can see, if we look at the yellow line, so the 8 daily exponential moving average, it didn't really appear very useful at first, because we often saw a massive divergence between the price action and the exponential moving average. Basically meaning that these candlesticks were quite far away from the 8 daily exponential moving average. Here it was above very much, here it was below by a lot, here it was above by a little, here it was below by a lot, and here above, etc., etc., etc. But actually after the earnings call, which is indicated by this red vertical line over here, it did start to track the 8 daily exponential moving average a little bit better. As you can see, the difference between price action, the candlesticks, and the yellow line is decreasing more and more, right? So it tries to stick very closely to that 8 daily exponential moving average. As we can see in the recent couple of days, we saw that first of all, the candlesticks were usually below the 8 daily exponential moving average, but right now on the 13th of January, we started to actually trade above the 8 exponential moving average, and even above the 13 daily exponential moving average. And today we're actually above the 21 daily moving average. So that's already a sign that we might actually start seeing a potential reversal of the trend. The second indicator we're going to take a look at is the RSI. RSI is standing for the Relative Strength Index. And this is a very strong indicator. I believe this has a lot of applications. First of all, the RSI is this blue line that goes up and down over here. And the white line over here is the exponential moving average on the RSI. It's basically the average price or the average RSI indicator, more or less. It basically indicates the average value of the RSI in the last 22 periods, the last 22 days in this case, because we are on a daily time frame, a daily schedule. As I've said before, the RSI has actually multiple applications, but in this video we're just going to focus on two of them. First of all, the overbought versus oversold. Usually what people say is when the RSI is above 70, and you can see these numbers on the right hand side over here, if the RSI is above 70, usually the stock is overbought, right? And usually when the RSI is below 30, then the stock is actually oversold. It's not as black and white as this, but let's just stay with these numbers, okay? Cool. So as we can see, on the 31st of December, it actually hit a quite low point on the RSI. It was actually below 30. So that could already give us one of the indicators, one of the first indicators that could mean that the stock is currently oversold. And the second application of the RSI is actually bullish divergence. Sounds really difficult. It's not that difficult. It basically means that the indicator is making higher lows while the price action is making lower lows. Let's see. So the indicator, the RSI in this case, is making a low over here on the 31st of December. And right here on the 11th of January, we can see a higher low, right? Cool. So we have a low and a higher low on the RSI. But if we zoom out, if we go to the price action over here, let's zoom in a little bit, we can see that the price action actually made a low over here on the 31st of December as well. But on the 12th of January, we see a lower low instead of a higher low. So again, indicator is making higher lows, but the price action is making lower lows. That is bullish divergence, right? So that usually means that the trend is actually strengthening to the upside, but the price action hasn't caught up with that just yet. And these are usually good signs of a possible reversal. Then the last indicator is volume. Volume is indicated by these vertical bars over here on the lower end of the screen, these gray bars, if you will. And the volume is basically the volume of the amount of shares that is being traded on a certain day, right? It's very important to have volume on significant reversals. If there's no volume, it could be a fake out. It could mean that the breakout is not real, it's just a fake breakout, right? A fake out. So let's just take a look at a few examples of good volume, of high volume. Right over here, we saw quite a lot of volume. It was higher than the average line over here. This white line is indicating the average amount of volume. So it was about above that line. It had a lot of volume. And as we see, this actually created a major high for that time. Here we also see a lot of volume, created this massive high over here. Here we see a lot of volume, created a massive low over here. A lot of volume over here as well, a massive high. And over here right now, we also seem to have a lot of volume, and this could indicate a massive low. So as we can see, the volume right now is very high, so that means that the breakout does actually look real. It doesn't seem like a fake out. So those were 3 reasons why I actually added to my Zoom position. First of all, the price action was above significant EMAs, exponential moving averages. Secondly, we saw that the RSI was actually on the oversold end, and we saw bullish divergence on the RSI as well. And third of all, we saw that the volume was relatively high. Now, something very important here is the word confluence. That basically means that there are multiple indicators indicating the same thing. Because if you, for example, only have good price action above exponential moving average, but you don't have a good RSI, you don't have any high volume, that means that it could actually be a fake out instead, right? But if you, on the other hand, have good price action above the EMAs, a good RSI, high volume, those are multiple indicators indicating the same thing. So that means confluence, everything is pointing in the same direction. Now, do keep in mind that this does not work 100% of the time, right? We could, of course, see prices even lower than the prices we are currently trading at, but technical analysis usually does give you pretty good guidelines to see when a trend is actually reversing. I hope you found this video helpful. If you did, then please consider sharing this video with your friends who are also investing in the stock market. With that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.